Imagine it's 2018 in Lebanon. You're a successful accountant named Kareem, 46 years old, living in Beirut. Your life appears stable. You earn approximately $4,000 monthly, a solid middle-class income. You have savings in your bank account, approximately $30,000 accumulated over years of prudent financial management. You have a mortgage on a modest apartment, monthly payments manageable with your salary. You contribute to a pension fund through your employer, believing you're securing your retirement. You have life insurance, purchased on expert recommendation for family protection. You have a car, financed but serviceable. Everything looks secure. Your children attend private school. Your wife works part-time. You've built something. Then, in 2019, you notice something. The Lebanese pound is weakening against the dollar. Inflation accelerates. Prices at supermarkets increase. Your salary, nominally the same, buys slightly less each month. You think it's temporary? Everyone says it will stabilize. But something feels off. You don't panic because nothing official suggests panic is warranted. This three-stage pattern isn't unique to Lebanon. It's repeated in Argentina, Venezuela, Zimbabwe, Greece, and dozens of other places, and it always destroys the middle class first. The pattern has repeated in Germany, Argentina, Venezuela, Lebanon, Zimbabwe, and Greece. In every case, the same thing happened in the same order, and in every case, the middle class lost the most. In Weimar Germany between 1921 and 1923, the trigger was war reparations. The government, unable to raise sufficient revenue, printed currency. The currency flooded the system. By 1923, hyperinflation reached terminal velocity. People who had saved their entire lives discovered their savings were worthless. In Argentina, in 2001, the trigger was a currency peg the government couldn't sustain. The peso devalued 70%. Savings denominated in pesos became nearly worthless. Pensions were cut. Bank accounts were frozen. In Venezuela starting in 2014, the trigger was oil price collapse. The government, dependent on oil revenue, faced insolvency. It printed currency. The currency devalued rapidly. By 2016, inflation exceeded 800% annually. In Lebanon starting in 2019, the trigger was a banking system that had become insolvent. The government, facing fiscal crisis, imposed capital controls. In Zimbabwe between 2007 and 2008, the trigger was hyperinflation caused by government printing currency. Inflation reached 79 billion% monthly. The specific trigger doesn't matter. The government's fiscal insolvency is the real cause. And when government becomes insolvent, the sequence of middle-class wealth destruction is always identical. So what are these three stages? And more importantly, what happens to middle-class wealth at each stage? This stage happens in plain sight. Prices go up. Your salary increases. You think it's normal. But what's actually happening is the most efficient form of wealth theft ever created. The mechanism begins when the government or central bank starts printing currency. They frame it as stimulus, accommodation, liquidity injection. The language sounds technical and necessary. What it actually means is simple. More money is being created without corresponding increase in goods or services. When more currency chases the same amount of goods, prices rise. Your purchasing power declines. This happens slowly at first, almost invisibly. You notice that groceries cost slightly more. Your electricity bill increased. School tuition went up. But your salary increased too, so you think you're keeping pace. You're not. The salary increase always lags behind actual price increase because government understates inflation in official statistics. Your bank savings earn 1% interest while actual inflation runs at 8%. You're losing money mathematically every single month, but the number in your account looks the same. Your pension fund value hasn't changed on paper, but its actual purchasing power is declining steadily. This is the punishment phase for savers. Meanwhile, those who borrowed money benefit initially. If you took out a mortgage at 5% fixed and inflation is actually 8%, you're paying back the loan with currency worth less than when you borrowed it. Your debt becomes easier to service. Borrowers gain, savers lose. The middle-class saver who did everything correctly is systematically punished. Venezuela demonstrates this stage clearly. Between 2012 and 2016, currency devaluation accelerated gradually. The first 2 years, savers thought it was temporary. By year 3, they realized it was permanent. Middle-class savings in bolivars became nearly worthless. Those who had converted to dollars or hard assets early retained their purchasing power. Argentina shows the same mechanism. The peso was pegged to the dollar, seeming stable. The government, however, was slowly inflating the currency. The peg was becoming unsustainable. When it finally broke in 2001, the peso lost 70% of its value. Savers discovered their trust in government promises had been misplaced. Lebanon illustrates a more subtle version. Banks offered very high interest rates on deposits. Savers thought these high rates compensated for slight devaluation. Actually, devaluation was much faster than interest rates compensated for. Middle-class pensioners who thought their safe bank accounts earning high interest would protect them discovered they were losing purchasing power despite nominal returns. The contrast is stark. Savers watching their wealth erode silently while borrowers pay debts with worthless currency. Asset holders watching prices rise while wage workers watch salaries lag costs. The middle class gets hit hardest because most of their wealth is in currency-denominated assets, savings, pensions, bonds, insurance products. The wealthy are diversified into hard assets internationally. The poor are already outside the formal system using barter and cash. The middle class is completely exposed. Most people accept this as normal economic cycle. Inflation happens. It's just part of life. But it's the setup for stage 2. And stage 2 is where the real acceleration begins. Your money is in a bank. It's insured. It's safe. Except it's not. When institutions fail, savers discover something too late. You don't own bank deposits. You hold a claim on an insolvent institution. The mechanism in stage 2 begins when currency devaluation accelerates beyond what the government can control. The government becomes desperate for revenue. It has already printed currency to the point where inflation is spiraling. Borrowing more becomes impossible or prohibitively expensive. The government turns to the one resource it can access directly, the deposits held in banks. Banks have become insolvent because they've promised depositors they can withdraw funds, but the banks have lent out most of that money to a government that can't repay it. The math doesn't work. The government has 2 choices: default on bank deposits or restructure them. It chooses restructuring. It imposes capital controls, restricting access to money. It activates bail-in frameworks, converting deposits into losses. It doesn't call it seizure. It calls it a regulatory measure, a temporary safeguard, an emergency procedure. Legally, it's all correct. But functionally, your money is frozen. The forms this takes are multiple. Capital controls limit how much you can withdraw. Greece in 2015 limited ATM withdrawals to €60 per day. A person with €100,000 in a bank account could access €60 daily. That's €1,800 monthly, while still owing property taxes, electricity bills, rent, food costs. The math doesn't work. You're trapped. Forced conversion happens when the government decides that dollar deposits will be converted to local currency at a rate the government sets, not the market. In Argentina in 2001, this happened over a single weekend. People went to bed with dollar deposits. They woke up to peso deposits at an exchange rate that had been artificially set by the government. A person with $100,000 on December 1st had approximately $25,000 of purchasing power by February. The government technically honored the deposits. It converted them as promised. But the conversion rate was designed by a government trying to survive, not by market forces. Bank holidays simply close banks. Deposits are frozen indefinitely. In Argentina, banks were closed for weeks while the government decided what to do. People couldn't access their own money. They lined up outside banks, demanding access to funds that were technically theirs but practically inaccessible. Negative interest rates tax savings through rates below inflation. If inflation is 8% and your bank account earns 1%, you're losing 7% annually in purchasing power. The bank is legally paying you interest. You're legally losing money. Deposit haircuts are direct seizures disguised as burden sharing. The government announces that deposits above a certain amount will be reduced by a percentage. 47% haircut, as happened in Cyprus, means nearly half your savings are confiscated through regulatory action. In Cyprus in 2013, banks had held deposits from across Europe. The euro crisis made those banks insolvent. The government, desperate for revenue and unwilling to default, imposed an emergency levy on deposits. Deposits above 100,000 euros lost 47%. This happened over a weekend with no warning. People went to bed with savings. They woke up to significant losses. In Greece in 2015, capital controls were imposed overnight. ATM withdrawals were limited to 60 euros daily. Elderly pensioners couldn't access pensions they'd earned through decades of work. The government called it a temporary measure. Years later, in modified form, the controls remained in place. In Argentina in 2001, the Carlito froze bank accounts entirely. People couldn't withdraw more than $250 weekly. Dollar deposits were forcibly converted to pesos at an artificial exchange rate. In Lebanon, starting in 2019, the banking system effectively collapsed. Depositors were told they couldn't access dollars. Banks forced conversions from dollars to Lebanese pounds at rates the government set. The actual purchasing power loss exceeded 90%. This stage destroys the middle class because their wealth is concentrated in institutional vehicles, banks, pensions, insurance products. They believe these institutions are safe because they're regulated. They have no alternative access to funds. Unlike the wealthy who maintain foreign accounts, the middle class depends entirely on the formal system. The psychological element is decisive. The government calls these measures temporary. Media normalizes the restrictions as sacrifice everyone must share. People wait for resolution that never comes. By the time they understand the situation is permanent, capital controls prevent them from moving money. But the freeze isn't the final stage. It's the setup for stage 3. And stage 3 is where middle-class wealth doesn't just disappear, it's actively redistributed. When governments become insolvent, they don't negotiate with asset holders. They take, and they use the legal system to do it. The question isn't whether they'll seize assets. The question is which assets they'll seize first. The mechanism in stage 3 begins when the government faces insolvency despite capital controls and asset freezes. Currency has been devalued. Banks have been drained. Access to deposits has been restricted. But the government still needs money to function. It must pay soldiers, police, bureaucrats, maintain basic infrastructure. The resources it has seized so far aren't enough. It must create new revenue sources. It turns to the most visible, most registered, most accessible assets, real estate, pensions, insurance products, business interests. These are all documented in government registries. The government knows who owns them. The government can seize them through legal procedures. It uses emergency powers to change the rules retroactively. What was protected yesterday is taxed or seized today. Emergency property taxes are the first tool. Greece in 2015 introduced a new property levy on all owners of real estate. This wasn't an increase to existing property taxes. This was a new tax that didn't exist 6 months earlier. The assessment was based on government valuation, not market value. Delinquent payments led to asset seizure. The tax was applied retroactively. Pension system seizures are the second tool. Argentina in 2008 nationalized approximately $30 billion in private pension funds. These were funds that individual workers had contributed to over decades. The government folded them into the public pension system. It promised that benefits would be maintained. Benefits weren't maintained in real terms. Inflation eroded pension values year after year. Retirees discovered that funds they believed were private and protected were neither. The government had seized them through legislative action and spent them on general operations. Forced conversions of insurance and bonds represent the third tool. In Weimar Germany, life insurance policies paid out their face value as promised. The problem was that the face value was in marks, a currency that had become worthless. A life insurance policy worth enough to buy a house in 1914 was paid out in 1923 in currency that could buy a newspaper. The insurance company honored the contract technically. The contract was mathematically destroyed. Real estate levies represent the fourth tool. Greece increased property taxes dramatically during the crisis. Lebanon seized property to cover shortfalls. Both framed these as emergency measures. Both made them permanent. The trap is that properties can't be sold because the market is frozen. But taxes are still due. Owners become trapped, paying taxes on assets they can't liquidate, in a currency that's becoming worthless, to a government that's becoming insolvent. Historical examples confirm this pattern. In Germany in 1923, the government seized gold holdings through executive order. It imposed emergency property levies. It nationalized businesses. Assets that were supposedly protected by property law were confiscated because the government was insolvent and the assets were visible. They were never restored after stabilization. In Argentina between 2001 and 2003, the pension system was partially seized. Property taxes increased dramatically. Vacation homes were subject to new levies. Tax liens were placed on properties. Many owners never recovered title because taxes accumulated faster than they could pay. In Greece from 2010 to present, emergency levies were imposed on property owners. The pension system was reformed, cutting benefits 40 to 60%. Insurance products were devalued. Emergency taxes targeted various assets. The middle class was destroyed while the wealthy with international diversification escaped. The pattern across all three stages is mechanical. Stage 1 erodes wealth silently. Stage 2 freezes access. Stage 3 directly seizes remaining assets. Understanding this pattern isn't about predicting when it happens. It's about understanding what's actually happening right now. Stage 1 warning signs are observable. Official inflation is lower than actual inflation. When the government says inflation is 2% and your grocery bills are rising 8%, stage 1 is underway. Your costs are rising faster than salary increases. When your salary increase doesn't match your cost increases, stage 1 is underway. Your purchasing power is declining month by month. When your savings buy less each month despite the same account balance, stage 1 is underway. Stage 2 warning signs are unmistakable. Capital controls are announced or negative interest rates are imposed. The government is restricting access to money. Restrictions on money access become policy. The window to move assets is closing. By the time stage 2 is announced, it's too late to act. Stage 3 warning signs are direct. Emergency property taxes are introduced that didn't exist previously. Pension reforms are announced that cut benefits. Forced conversions or wealth taxes are implemented. When the government introduces a tax that didn't exist 6 months ago, stage 3 is underway. Why this pattern is inevitable is mathematical, not political. Insolvent governments consume accessible resources. This is math, not ideology. This is survival mechanism. It applies to democracies and autocracies equally. It applies to left-wing and right-wing governments. The political system doesn't matter. The fiscal math matters. When government becomes insolvent, it consumes accessible resources to survive. The specific asset targeted varies, but the mechanism is identical. The question isn't whether this pattern will happen somewhere. History guarantees it will. The question is whether you'll recognize it before it becomes personal. The pattern is already in motion somewhere right now. The question is whether you'll understand it before it becomes personal. Return to Karim in Lebanon. It's now 2023. The worst of the crisis has passed technically. The economy has stabilized technically. But Karim's wealth has been systematically destroyed through all three stages. His savings were eroded by inflation that far exceeded official statistics. His bank accounts were frozen by capital controls. His pension was cut by government reform. His property taxes increased through emergency levies. He's alive. He's housed. He's employed. But his purchasing power has declined 90%. He has learned what he will never unlearn. Every purchase and investment he was told was smart, stable, and responsible turned out to be a bet placed on a system that failed. Current indicators show the pattern is already advancing somewhere. Global debt is at historical highs. Interest payments are consuming larger budget share. Central banks are experimenting with negative rates. Capital controls are being tested in various countries. Asset seizure frameworks are being built. This isn't about if, but when and where. The pattern repeats in cycles. Recognition comes too late for most, but early recognition changes options. The framework for thinking about your assets is straightforward. What assets do you hold? Where are they held? Can they be frozen, seized, or converted? What would you have left if formal systems failed? This channel doesn't predict futures. It dissects pasts. The pattern has repeated in Germany, Argentina, Venezuela, Lebanon, Zimbabwe, Greece. It's repeating somewhere right now. The question is whether you'll position like someone who understands the pattern, or whether you'll be destroyed like someone who didn't. That choice is yours. That choice is now.